Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, and see what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com is where I dive deeper into all of these topics and subjects, looking for potential investment opportunities. We've got a coupon code special that is active, and you guys can see in the description link those specials. So HFI Research says, I think the JPM oil team is my favorite. This is JPM, JP Morgan, Global Implied Oil Supply Inventory. And where are we locating? We are eating through inventories. Ever since about mid 2023, we've been in a deficit, declining on inventories. Now, are we going to get a recession? Is a slowdown going to come? I don't know. I don't think a lot of people know that. I've heard a lot of people saying that they think they know, but I'm not so sure. Just because a lot of things are being messed with, like the short end of the yield curve or the short end of bond market and yields on that short end. I think they're releasing a lot of bonds, which increases the yields on there from a supply demand perspective. So they also play with inflation. They play with GDP because GDP's inflation is calculated in using GDP. So that's what we've got going on here. That's what's reported. We're eating through inventory levels of oil, and that's kind of where we're at. Casper, this is CEF. Gold and silver has broken out and is a major bullish uptrend, just like in 2002. This is CEF, Physical Gold and Silver Trust. It's a mix of the two metals, and you can see that we've broken out and are mid-stride running. So that occurred after the slowdown in last bull market. So the slowdown occurred. We have the same fractal formation. So if you look here, this fractal formation in 1999, 2000, 2001, it's all pulled through there, and then we broke out. We have that same fractal formation, and it pulled down and bottomed in September, October of 2022. That's right here. So this guy here and this guy here are the same. This entire fractal is very similar to this entire fractal. So it's just squeezed up and moved a little bit different. So this low point in 2016 would be the low point here. And we ran up, hit resistance. This consolidation fractal is the same consolidation fractal back here. Pissing away trace silver post World War II. And this is production. The demand is in the green, and you can see there's a difference between demand and production. That difference is the deficit that we've been running, and we're running larger and larger deficits and eating through inventories of silver. So basically, we're converting silver into products. And then since we've got a lot of inventory of silver around the world, prices come on up, people sell their silver, and then that supports production of whatever there is out there that it's going to go into. This is silver on a big long-term, big picture view. Silver on a line chart on the 12 monthly candlesticks on the cusp of or have already broken out of the yearly close here. And there's the cup and handle. And again, the short-term market movements have not hurt or destroyed this pattern. I mean, there's got to be a lot of selling pressure to basically get this thing to null and void this large pattern. So I think we're still in an advanced phase, as you can see here, and everything's intact. Here is silver. So silver, if you think today's price action hurts, wait until you miss the real move up in miners. I can tell you from personal experience, I still haven't recovered from 2016. If you are out, I genuinely wish you the absolute best. We had a little bit of selling pressure in the miners the past couple of trading sessions. So I pulled up GDXJ, and what he's talking about is this move here. And I think this move will be nothing compared to what is coming over here. So I'm in the camp that we're going to get a huge move in the mining companies coming up any second. Some of them have already started the move. Some are still needing to break out of the basing pattern. This is the base pattern here. This is GDXJ, and I think we're going to see a big move. We could see a slowdown in the market first. It is definitely possible. And then they lower interest rates or they come up with some sort of stimulus. Maybe it's $5,000 checks that Trump wants to do. It all kind of interconnects with each other. I think that these are just impulse moves off bottoms. And then you can see the small selling pressure. We squeezed up into a bullish engulfing, and this looks fantastic to work its way on up out of the base pattern here. So this is the big stage 2 move. This is a stage 4 decline, stage 1 base, stage 2 move that I see here in GDXJ. Coming on back, we've got Jim Bianco. This is what people are attributing the strong selling pressure yesterday to this. Jim says this story is out today, not 5 years ago. I'm being told it contributes to the equity sell-off and bond rally, aka risk-off rally. Seriously, are we going to do this again? The new coronavirus with potential to cause pandemic discovered in China. Well, it's in a lab. Like, why are people getting worried about this? I don't even think it's in humans. But are we going to do this thing again? I don't know. And you know what? They always release this crap right when everybody's positioned in bonds. When the yield curve's inverted, and then they try to basically scare everyone to sell their stuff to the downside and get everyone, and basically create the volume for the banks to swap over to something else. If the banks want to sell their overvalued stuff, they're probably selling it to retail now. Then they got to create some sort of panic to create the volume that they can buy large amounts of money with in whatever's going to be coming up that's good. In this instance, it would be precious metals and commodities and stuff like that. David Burrows says transitions take time to play out. Putting this out there, there is a change afoot. We have to see the world for what it is, not what it has been, and adjust positions accordingly. And this is gold relative to QQQ, and it's the cycle. So gold relative to QQQ is what this is. If I were to do it myself, let me see if I can get a little bit more data here. I view it, we can use it IXIC, and it should be the same pattern. So what this is we had a gigantic bull market in gold in the 1970s that peaked in 1980. Interest rates are a driver of this, of money rotation. So money got scared into gold and out of the NASDAQ in the 1970s, peaking in 1980. We had a huge reversal in 1980 between gold and the NASDAQ. The NASDAQ ran from 1980 all the way down to 2000. This was a lowering of interest rates. Money was swapping or moving from hard assets to financial assets. Then we came all the way to the bottom here. And I think that we are putting in a double bottom. So bottom 1 and then bottom 2 is what we are using at this exact moment. And we're trying to break out of this downtrend. So if I were to squeeze up the downtrend here on this, we're trying to break through this downtrend line, which we're doing right now. Gold is the leader. The reason gold's the leader is because it's the safe haven asset. And a lot of the times you get a turn of gold outperforming the NASDAQ under the conditions of the NASDAQ peaking and gold being the safe haven asset rotating upward. So a lot of the times it's from a shift of money into gold out of the NASDAQ, which occurs under the market conditions that gold goes up and the NASDAQ goes down. So that's generally a slowdown in the markets. Now, does that have to be, in this exact moment, does it have to be the slowdown where the NASDAQ crashes? It doesn't have to crash. It could go sideways as money rotates into it. So I'm not 100% sure that you have to have a quote recession. That could have already occurred in 2020. And then we also had another one potentially in 2022, which was here, 2022. 2020 was this guy here. So we might have already had that slowdown in 2022. Tough to say. There could be another slowdown. It is really a tough one. And then money starts to rotate into gold and it rotates into commodities, and that's the cycle. So it's occurring right now. We're getting that breakout basically as it's happening right in front of our face. And then we're coming from, if you look at a lot of these technical analysis books, what I think will occur is that this is going to be I hate when this happens. It's going to be a double bottom. So here's your double bottom. This is going to come all the way up. It may break out, pull back, and then go up again. And if we go all the way up here, I mean, this is like the best investment you could potentially make of like all time. This is like buying. Here, let me see if I can get a little bit more data on here. It's XAU USD, and that's going back to 1973. So what we have here is the double bottom, and this is from a long-term perspective. It's bottom one, bottom two. We've broken out of that downtrend over here. If we get back up to the 1980 highs, which is way up here, I mean, this gold and silver and maybe platinum and some of these other ones would be the best investment of like anyone's life, buying it down here at this double bottom of the bottom. Another thing that would do really well, I think, is commodities because it's so cheap. This is so cheap, it's unbelievable. Now, even if you have to wait in this for a year or two or 3 or 4, it doesn't matter because the payout will be so big on the back end and the risk taken so little with gold. In 1971 to gold was $35, $38 an ounce in that general area. It ran all the way to 850 up here. Silver did a 50 bagger. So when this comes all the way back up, we could see bigger returns than that if it were to do that over time, because we're starting from such a low level. We're starting from the level down here versus this is 1973. I can't remember what the price is, but it was probably started from like down here or something like that. We're probably lower today and cheaper today on a ratio perspective against financial assets, gold is, than the early 1970s. Huge opportunity. Gergen says, days of supply of natural gas has been absolutely nosediving with one of the coldest winters in the last 15 years. And here we are coming way down to about, 14, 13, 12 days of supply of natural gas in inventory. We are real low right now. AI is inflationary, says Jim. It says, last week, the New Jersey Board of Public Utilities said its residential customers' average monthly bill is expected to increase by 17 to 20% for the 12-month period starting June 2025, partly due to data center-driven demand growth. AI is inflationary. Eric Yoon says, delivering the physical gold to the COMEX from the LBMA further stresses the LBMA's physical gold availability. Therefore, it will probably further dump the prices of the bullcrap LBMA paper gold, forward contract promissory notes. This will compel others to try to to try taking physical delivery at the LBMA or elsewhere to delivery at the COMEX because they're short COMEX paper, gold long LBMA paper, gold trade is taking huge unrealized losses. It is an EFP doom loop. So what he's saying is people are going to become weary of LBMA paper. As people don't want to buy the paper market, the price falls. As the price falls, people are more likely to take delivery or try to on the LBMA because it's cheaper on the LBMA exchange than other markets because people think that it's not legit. So as the LBMA paper market declines because of the demand for paper, more and more contracts are going to stand for delivery because you can get the gold cheaper through that exchange. It is a EFP doom loop. The doom loop is the unwillingness for people to buy the paper markets, which means the price goes down. And then people will say, well, it's cheap. I'm going to wait and see if I can stand for delivery, which then creates a bigger problem. Everyone's standing for delivery because of the cheap paper market that the LBMA is going to face. There's the doom loop. And this is the other portion of it is some of the shorts can be closed by delivering gold to the COMEX and issuing to those contracts which are stopped. But other longs are rolling over and going further out of the curve as it's profitable for them to do so. So this problem that the shorts face is not going away. Coming on back. So here's Warren Buffett's dad. Somebody asked me a while back, uh, how do we fix our debt problem? What's the problem? We need a fixed money supply, all this yada yada yada. How would I fix it? What is the root cause of the problem of our government printing all this money and stealing it? So here is Warren Buffett's dad. It says the greatest speeches on gold, part one. Human freedom rests on gold redeemable money. Warren Buffett is possibly the greatest investor of all time, but did you know that his father, Howard Buffett, a congressman from Nebraska, gave one of the greatest speeches about gold in history? In 1948, just after World War II, he argued that the gold standard is essential to human freedom. He said that paper money or fiat money allows politicians to inflate the currency, leading to economic instability and ultimately a loss of individual liberty. Under a fiat money system, citizens have no control over the value of their money, leaving them at the mercy of government spending decisions. He warned that failing to restore sound money could lead to widespread inflation, economic chaos, and potential social unrest. Before 1933, whenever the people became disturbed over federal spending, they could go to the banks, redeem their paper currency in gold, and wait for common sense to return to Washington. Our finances will never be brought into order until Congress is compelled to do so. Making our money redeemable in gold will create this compulsion. He ended with the call to action. Unless you are willing to surrender your children and your country to galloping inflation, war, and slavery, then this cause demands your support. For if human liberty is to survive in America, we must win the battle to restore honest money. Says, what do you think? Was he correct or not? He's completely correct. He is completely and 100% correct. And it must be gold and silver, nothing else. The reason I say that is we need something that is limited by nature, by the environment. These are two elements on the periodic chart. It's not made by humans. It can't be manipulated. Nothing like crypto because that's all man-made. I think that gold and silver are the best things that we have found in nature to use as money. I don't think that using a human designed money is going to get us anywhere. We need it to be hard and we need it to be limited by nature. I think he's right. And that would solve the root cause of the problem, which is Congress doing whatever the heck they want and buying votes and buying this and buying that. All of that is blocked. They can't do any of that on a gold and silver backed system. And we don't have to do anything. It's already written in our Constitution. Just use it. Warren Buffett quote, all there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. And he wants to hold some of these stocks forever. No reason to sell whatsoever. High Heat says fair value of Brent crude oil is $90, probably higher. Enjoy your weekend. I like the short, just hey, fair value, throw out $90. Brent crude. NASDAQ has its highest share of money supply in history. Prepare accordingly. Different this time? I doubt it. I totally doubt it too. We're going to roll over at some point. Calling the absolute top, difficult to do. But yeah, I agree. I think at some point you can look at the fractal movements too. Maybe this move here is this last one. You can see we had the squiggles here. We had coming all the way back. So maybe 2009 is analogous to 1991, perhaps, because that was right after a recession. You have this move there, which is this move there. Then you've got the squigs. You get the squigs, and then you get the pullback, and maybe this pullback you get this move on up, coming on up here. I bet you we're pretty close. Maybe it goes up a little bit more, or not. We'll see. Smart Real Estate Bets, it says, I call a 4.9% decline moderate. He's talking about home sales in January. But that's immaterial. On average, the month-over-month change in home sales from December to January since 1999 is minus 26.3%. A 4.9% decline for January is actually fire. It's actually a really hot market. These are the declines that we saw in the previous years, 21.2, minus 29%, minus 31.4, and minus 32%. As you get the point, seasonality matters. She's a hack. And they're responding to this home sales drop sharply as prices hit all-time high for January. But it's actually, you need to see that that's a normal thing that occurs every year through seasonality. And 4.9% is actually a very small decline. Where the housing market shift is happening the fastest right now, it says active U.S. housing inventory for sale according to Realtor.com. This is going back to 2018, and 2018 still had very low inventory. So don't think that this is high inventory up here. High inventory is up towards like 2 million plus. Back when we had a problem, I think the inventory levels were like 4 million. So like 2.5 million, that's more kind of like an average market. We're still at a very, very, very low active inventory of only a little over 800,000. But it has come and is starting to normalize to the upside. Don't worry, I'm sure this is just the beginning of the bull market. Obviously, he's joking. It says 89% of fund managers now believe U.S. equities are overvalued. That's the most since the dot-com bubble. Probably fine. Saying that U.S. equities are overvalued. Natural gas inventory levels over in Europe. We've got France is at 23.76%. That's getting down there for inventory levels. Netherlands at 29 and Germany at 38%. This is the EU natural gas inventories in percent full, and we're at about, I don't know, about 40% or so of inventory levels. Just slightly above 40% is what it looks like for 2025. And we're a little bit below the average, the 2017 to 2021 average. Freight futures, AM update, dry bulk was down 1% and 2% for Capesize and Panamax, and tankers were down 1% for VLCC and Suezmax. Here is Tavi. He says probably nothing. Swiss gold exports to the United States. Look at that. Huge spike. We had a spike in 2020 as well, and another spike occurring right now. David Morgan says it will only take 22 days at the current pace to drain the silver. So let's read what Bob Coleman says. He said, attention, all of those who are trading the EFP futures paper market on silver equals the short COMEX futures contracts and long spot or spot deferred contracts, meaning they do not have the metal, but rather a promise from a counterparty. Let the following sink in. So January silver outflow from the LBMA vaults was a staggering minus 71 million ounces. It's the largest on record. It brought the monthly pace of outflows since Trump threatened tariffs to minus 33 million an ounce per month. And the LBMA holdings at 760 million ounces, it will only take 22 days versus gold's 100 days for the current pace to drain all of London's silver. 22 days at current pace. Yeah, I'm not selling my silver or gold. Another one with Tavi says silver made another notable move today, steadily rising under the radar. The derivatives of gold are now playing catch up to the metal. It's worth noting that the gold to silver ratio remains near 90, one of the highest levels in history, creating a compelling asymmetry. Lastly, and most importantly, when adjusted for the money supply, silver's price presents one of the most bullish setups I've seen as we're coming on up for silver, adjusting for the money supply. And that occurs under these commodity bull markets. So we've got a same fractal here. This fractal, when we came on up, you can see the fractal there coming on up, and we've broken to the upside. We're trying to break through this base right now. We're right at resistance of silver divided by M2 money supply. And then I think we're going to get rolling here. So this fractal there, I think, is right at the beginning of like 0203, somewhere in there is kind of where we're at. And this generally gets moving when the dollar starts to fall, the DXY. It's the relative weakness of the dollar. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that special coupon code going on. We've got a question and answer session coming up at 5 p.m. Sunday, Mountain Time, where we're going to go over companies and what drives stock prices and kind of go through the cycles. So that's what I've got, and we'll catch you next time. This is Finding Value.